Most people want to get wealthy but don't know how or where they stand in the process of building wealth. If that sounds like you, then this video is what you've been looking for. I have read 50 plus books on finance, business, and money mindset, worked in the finance industry for the last 5 years, and even wrote a book on personal finance. And I have learned that there is a distinct formula for building wealth. But for Black parents, it's not exactly
what the gurus have been telling you.
I call it the prosperity pyramid. In this video, you'll learn a step-by-step guide to improving your financial situation. And I will reveal the number one thing that is holding back your financial progress. We will build the 9 layers of the prosperity pyramid layer by layer. And by the end of this video, you'll know exactly where you stand and what you need to do next in order to get your finances together. It all starts with crafting your financial picture. Diving into your finances can be scary sometimes. We don't want to open the bills. We don't want to look at the debt. We don't want to do some of these things sometimes. But this is going to empower you beyond means. You're going to get so much value from just understanding what the situation is. Now, there are 6 things that you need to do or need to evaluate when you want to develop your financial picture. The first is going to be reviewing your income sources, annual and monthly. The second one's going to be evaluating your expenses, both on a monthly basis and on an annual basis. The third is going to be capturing your assets. What are the things that are actually helping your net worth grow? Do you own a home? What are some of these assets that you have that can say, hey, listen, this is growing my net worth? The fourth thing is going to be getting real with your liabilities. Do you have student loans, credit card debt, a mortgage? What are these things that are anchors holding you down? They're not trying to allow you to move forward. The fifth thing is going to be reviewing your credit report and your credit score. Capture this data because it helps you understand if there are things on your credit report that are not being reported correctly. You can dispute those things, and then you can understand where you are when it comes to your credit score. Are you in an excellent position or are you in a poor position when it comes to what that rating is? And that way you can do things in order to improve it. And your sixth thing is going to be evaluating your estate plan. So what happens when you're no longer here? Your will, your trust, your life insurance, are those things in order? By having a complete picture, it helps you understand what you need to do when moving forward and actually developing this wealth plan. Now, I have another video that covers this topic in more depth, but this is the essence of crafting your financial picture. So now let's transition to the second layer of the prosperity pyramid, which is improving your income streams and reducing your expenses. This is a good time to evaluate your spending habits and understand the things that truly make you happy and cut the things that don't. For example, are you spending too much on subscription services and streaming services? Are there things that are underutilized? I just went through and cut things like HBO Max because I didn't use it very much. Are there things inside of your budget that you're just not getting enough value from that can be easily cut in order to save some money? Most call this thing a budget and actually crafting a budget for your monthly expenses. But I like what Ramit Sethi from the book, I Will Teach You to Be Rich, he calls it a conscious spending plan. It's being aware of the things that you're spending money on. And again, what makes you happy and what can you do without in order to fund the goals and things that you have going in the future. Now, while you're doing this, see if there's ways that you can bring in an extra $50, $250, $500 per month. Is it things like, becoming a dog walker, doing some door dashing or Uber? Are there different ways that you can bring in some extra money in order to spread that gap? Because it's not about how much money you bring in, it's about how much money you keep. When it comes to the discretionary income, how can you widen that gap between the amount of money you have income and the expenses you have in order so you can have discretionary things that you can put that money to work in different ways. And the reason why we're doing this is to make sure that we can fund the most important thing that can derail your wealth building journey, which is your short-term emergency fund. Your short-term emergency fund is the money you tap when something comes up you don't expect. Maybe the pipes in your house freeze, you need new tires, or you have an emergency medical expense. Most of the gurus
State you need $1,000 in your short-term emergency fund.
but that only makes sense if you're a single person with no dependents. You should plan to have $1,000 for every person that's financially dependent on you. And since this is the Black Parent Finance channel, I assume that you're caring for more than yourself. Say, for example, is you and a child, you should have $2,000. If you have a family of 5, then you should have $5,000. Now, what I suggest is that you only go up to about $5,000. And the reason why I said that it needs to be a per dependent basis is because your probability of an emergency happen increases because there's more people. And because there's more people, multiple things can have the ability to happen at one time. So you need to have more in your short-term emergency fund just in case one of those things happen. Just say, for example, you have your child breaks their tooth and they need to go to the dentist and get some emergency work done there. And at the same time, you have tires that need to be replaced. This is why you need to make sure you have a larger fund in order to make sure you're still on track with the rest of your goals. You need to have this in place so you can focus on eliminating consumer debt. Consumer debt are things like credit cards, store cards, personal loans, auto loans. These are eating up extra money inside your budget every single month. Credit cards and store cards are accruing interest at a rate between 28% and 33%,
which is crazy.
Auto loans have rates between 7 and 21%. So you have to really understand that this is things that are just eating up extra cash that you can be putting towards better things. As Robert Croak from the Rich Habit podcast states, and I'm a huge fan of that show, by the way, you cannot out-invest high interest consumer debt. So focusing on this essential thing is key to building wealth for you and your family. There are 2 popular methods to eliminate this high interest consumer debt, and that's the avalanche method. The avalanche method focuses on paying off the highest consumer interest rate you have first, and then going from that point, using that money that you paid off, that you would typically say is $300 or $400 a month, and then you put it into the next highest interest. Now, the benefit of this is because just say you have a card that's at 30 or 33%, once you pay that off, it's no longer accruing that interest. And then now you can also put that to the next debt you have. The snowball method focuses on paying off the debt that is the smallest first. So just say you have 3 credit cards, one has a balance of $1,000 and the next one has a balance of $2,000 and the next one has a balance of $5,000. You would pay off the one that has $1,000 first and then use that money to put into the next, and then so on and so forth. You kind of snowball into the highest one. That way, when you get to the $5,000 credit card, that now has a bigger chunk of money that's contributing to paying that off. These are 2 popular methods in order to get your debt eliminated and paid off. Once your debt is paid off, now you can focus your attention on the 5th layer of the pyramid, which is your long-term emergency savings. This is 6 to 12 months worth of expenses. So your long-term emergency savings is probably the most important piece of becoming wealthy in the future, because it helps keep you on track and allows you to have that financial security for when things happen, such as a job loss, or you want to take a career break. Maybe you had a breakdown. You're just like, listen, I can't work for a few months. I just need to just reset and kind of do my own thing. It also allows you to start a business or anything like that. Having this amount saved can also allow you to start contributing to your retirement accounts without interruption, which brings us to our next topic, retirement contributions. Most gurus state that you need to start
contributing to your retirement account
as soon as possible, as soon as your first job even. So people often do this before they have the emergency fund set up, or they've paid off their high interest debt.
I know.
The earlier you start contributing to your retirement account, the more you'll have in 30, 40 years when you want to retire because of compound interest. I mean, you may even get an employer match and there's some tax benefits. This is all true. But one of the things I found is that when people get in financial duress, they often dip into this retirement account to fund emergency expenses, taking out a 401k loan or taking early withdrawal penalties, which is 10% plus taxes on what's ever been withdrawn. This eliminates the benefit of contributing to a retirement account. If you're just going to withdraw the money, you might as well put it in the correct account type. It's better to set yourself up for success by starting this after you completed the previous layers of the prosperity pyramid. However, if you have paid off all your high interest debt and you have a fully funded emergency savings account, this makes plenty of sense to invest in the stock market via your retirement account or other methods. Which brings us to our next layer, investing in the stock market with a personal brokerage account. Now, your personal brokerage account is an after-tax account that allows you to invest in the stock market, which is one of the easy and most direct ways to keep your money working for you and beat the rate of inflation. It has consistently produced 8 to 10% returns over the last 30 years, and you don't need a financial advisor to get started. There are sites like public.com, Robinhood, Cash App, SoFi, Stash, and many, many more that allow you to purchase stocks all on your own. The smartest investors keep it simple. They invest in ETFs like VOO and VTI. VOO is an exchange-traded fund that invests in the S&P 500, which is the 500 largest publicly traded companies and has low expense ratios. VTI is a Vanguard exchange-traded fund that invests in the total stock market. It always holds approximately 1,300 stocks and again has low expense ratios. Both of these are great to start with because they perform well over time and keep your money diversified. Your goal is to build this personal brokerage account between $50,000 and $100,000 to develop your wealth base outside of your retirement account before going after assets that have larger returns, such as alternative investments. So alternative investments are typically investments that are outside of the stock market, include things like real estate, artwork, wine, purchasing businesses like small businesses, investing in startups, cryptocurrency, and many, many more. These investments can sometimes yield larger returns than the stock market, but can be more risky, can take longer to break even, and provide a return on your money. This is why you should only invest in these options when you've completed layers 1 through 7. However, when you get here, there are often other things you can do to save money in the form of taxes, which brings us to layer 9, incorporating tax saving strategies. By this time, you've probably already been doing things like investing in your retirement accounts and other things that are producing tax savings. But this is the time you want to hire a great tax accountant to better understand other strategies you could be employing to reduce your tax liability. A great tax accountant is a lifesaver. Do your research, ask friends, and start saving that money. At the beginning of this video, I promised that I would reveal the number one thing that is holding your finances back from progressing year after year, and I'm not going to bury the lead. It is focus. Right now, your money is multitasking and making no progress. You have to focus all your extra dollars on one thing until you complete that goal. In the book, The One Thing by Gary Keller, he repeated this one quote: "What is the one thing I can do such that by doing it, everything else will be easier or unnecessary?" This quote applies as well to your money as it does to work. By individually focusing on each layer of the prosperity pyramid, you will make tremendous progress on building wealth for your family. Too many gurus are telling us to pay
off our debt while also saving for retirement, while also investing and saving for an emergency fund.
Your money is doing too many things and struggling to make significant progress in any one of these areas. Identify where you are on the prosperity pyramid. If you haven't crafted your financial picture, that's what you need to do next. If you haven't identified ways to improve your income or reduce your expenses, start there. Everyone should be able to see where they are and what to do next in order to build wealth for you and your family. Thanks so much for hanging with me and learning more about the prosperity pyramid, the 9 layers to building wealth for your family. If you would like to go deeper on any of these topics in a community setting, I have started an online community called the Pumpernickel Club to help Black parents build financially strong families and secure brighter futures. If you enjoyed this content, don't forget to like and subscribe, as it would help out the channel tremendously. All right, peace out.